Hey everybody, Marty Mazur, good afternoon. It's the 23rd of August 2016, your Tuesday video. No stock charts today, or at least no technical charts. I may bring that to you a little later in the week. But today I just want to talk about the Fed. They're having their Jackson Hole, Wyoming symposium this week. It's been a meeting that can move markets. It certainly has in the past. So I thought it might be timely to talk about the Fed, talk about its impact on the market, why the market seems to be so sensitive to the Fed, or perhaps why the Fed is so sensitive to the market. And I want to illustrate for you what I believe is the biggest single factor that is keeping them somewhat at bay when it comes to tightening monetary policy, and why I think they're going to be, or they're going to continue to be quite gingerly on hiking interest rates going forward. So to begin with, the chart in front of you shows the Fed funds upper bound. That would be the top of the range for the Fed funds rate target. Currently, it is 0.25% to 0.50%. And you can see we just went from 0.0% to 0.25% to the current level back in December of last year. Next chart shows you the impact, or the potential impact, that raising interest rates could have on the value of the dollar. The blue line is the Bloomberg US Dollar Trade Weighted Index, and as you can see from about mid-2014, I can tell you that was a time when there were lots of rumblings, lots of concerns about the Fed beginning to raise interest rates. See how dramatically the dollar had risen and stayed at a relatively high level and peaked just after the Fed finally did raise interest rates in December of last year. The reason, by the way, for a higher dollar would be the interest rate differential. When interest rates in one currency are higher than other currencies, then traders tend to want to borrow in the lower yielding currency, pay a lower interest rate, and then earn a higher return in the bonds, if you will, generally the sovereign debt of the country is paying a higher yield. So why would that be such a concern of the Fed? Well, the next chart shows you the year-to-date correlation between the dollar, again the blue line, and the S&P 500, let's say the US stock market. Notice how negative that correlation has been. Early in the year, as the dollar began to decline, you can see that the S&P caught some wind in its sails and began to increase. When the dollar started to rally this year, you can see the S&P struggled a bit, and you can see that that relationship, or that negative correlation, certainly does seem to continue, at least at this juncture. Now, historically speaking, that hasn't always been the case, and I do want to add that historically speaking, it's not always the case that the interest differential alone will create a higher currency. Other things come to play. Certainly the health of the economy can lead to a higher or a stronger currency as well. And sometimes higher interest rates do not lead to a healthier economy. And indeed, a higher dollar isn't always beneficial to the economy. Now, it's great for you and I as consumers because we can buy more stuff that we import from abroad when the dollar's stronger. But take a look at the chart showing U.S. industrial production, the green line, against the blue line, the higher dollar, the Bloomberg Trade Weighted Index. As you can see, it appears as though the correlation of late has been negative there as well. As the dollar has gone up, it can be a headwind for manufacturing, certainly for exporters. As I suggested, for us as buyers of imports, consumers, it's good. But for foreign consumers buying our exports, it's not so good. So U.S. multinational companies who look to foreign markets for their profits see the dollar, rightfully so, as a headwind in terms of the amount of business they do abroad. It's also showing up in the index of leading economic indicators, the purple line in the chart you now have in front of you. So if the Fed's goal is to create the landscape, if you will, the backdrop for a healthy economy, the dollar can be somewhat problematic, and I would suggest to you folks that it is indeed the dollar that is at the top of the Fed's list at the moment. You see, the rest of the central banks in the world, almost across the board, are in an easier mode than we are here in the U.S. They are looking at more creation of currency, more quantitative easing, the buying of debt off their bank balance sheets and so forth. In Japan's case, buying of just about anything they can get their hands on. So essentially instituting policies that can be real depressors of their currency and in effect boosting their export sectors. So again, when the rest of the world is being so easy, if the U.S. begins to tighten, their concern is the dollar's really going to take off and it's really going to have a negative impact on the economy. So as you've heard me say here many times, I don't envy these folks. They have a very, very tough job. I think they have been overly sensitive to financial markets. I understand why. And right now they've got themselves kind of boxed into a corner because of the relationship to other central banks, to the US dollar in terms of what a higher interest rate at this juncture might mean. So while I do suspect that the market may have it right, Fed funds futures right now are discounting a little better than a 50% rate hike in December. I'll be surprised if it comes any sooner than that. I do think that this Fed is getting impatient. I think that certainly the employment numbers and I believe the coming inflation numbers are going to support another Fed rate increase sooner than later. And I think they're just going to have to deal with its impact on the markets and on the dollar and potentially on the economy. But when they do it, they're going to have as high a confidence level as they possibly can at that juncture in terms of believing that it's not going to have too bad an impact. But I do think there will be some reaction for sure. Thank you, folks, as always, for watching and listening, and I'll talk to you again a little later in the week. Take care.